Good morning, everyone. Welcome to the Vetiva breakfast meeting. Today is another special edition as we'll be having Ibuku Omayani, who is the economist at Vetiva and Research, and he'll be speaking to us on fiscal sustainability, reform price dilemma. But before this, we'll have the usual rundown of the equity and fixed income market, as well as media updates across Africa from our media partners at Frontier Africa Reports. As usual, we'd like everyone to know that the meeting is being recorded and may be shared, and the recording may be shared with third parties. It's also being broadcast live on our Facebook page, that's Vetiva Online Facebook page, and if you'd prefer to, you can view it from there. During the course of this session, you may ask your questions using the Q&A chat box or the Q&A or the chat box, respectively. Or you can send your questions in using the comment section on Facebook, that's if you're joining from Facebook. We'll also have a Q&A session after all presenters are done speaking. So if you prefer to speak, you may use the raise hand function and we'll call upon you to ask your question or make your comments. To kick off the session, we'll be starting with fixed income market analysis by Omorege Ogogo. Good morning, Omorege. Please go ahead.
Good morning, Chima. Good morning, everybody. I'll be taking a recap of the Nigerian fixed income activities for yesterday. I'll start with the money market. The money market opened positive again yesterday. Opening figures for Tuesday was around 100.44 billion positive on the back of OMO repayment of about 80 billion that came into the system yesterday. This was a slight decline from Monday's opening figure of 112.44 billion. Despite the slight decline in system liquidity, money market rate maintained to trade around 14.3% levels. We expect the money market to trade at lower levels today, barring any major change to the system. Moving on to the FS market, the parallel market maintained to trade at 502 Naira to $1, while the earning window traded at 421.96 Naira to $1, closing at 411.50 Naira to $1. That's a 43 kobo drop from where it closed on Monday. The industry turnover decreased significantly by about 58.5% to close at $62.79 million on Tuesday from the $151.37 million recorded on Monday. We believe the Naira will continue to hover around these levels, barring any major policy adjustment by the regulator. Moving on to the T-bills market. T-bills market traded on a bullish note yesterday as OMO repayment of about 80 billion, which came into the system yesterday, spurred buy-side interest in the market. Buy-side pressure was majorly on the newly issued one-year paper, that's the May 26, 2022, and the long-dated OMO papers. As a result, offers on the newly issued one-year paper dipped by over 10 basis points to settle around 9.2% levels in the market, while the bids were around 9.35% levels. Offers on the long-dated OMO papers were around sub 9% levels, precisely at 8.5 levels. We also saw some buy-side interest on the newly issued special NTB at around 9% levels. Overall, a few trades were consummated across the curve because of the disparity of the bid and ask. There's an NTB auction today where the DMO is offering a total of 91.31 billion across the three usual tenors. The total amount on the 91 days is 4.74 billion. We expect the marginal rate to maintain on that end. The 182 days, the total amount on offer is 7.82 billion. We also expect the marginal rate to maintain, while the 364 days, the total amount on offer is 78.71 billion. We expect the marginal rate to close between 9.65 to 9.85%. The stop rate on the one-year paper will most likely close higher than the previous stop rate, which was 9.65% on the back of the increased amount on offer. And also, given that the major driver of the dip recorded at the last auction was the reduced amount, which was 19.8 billion on offer, which caused a lot of players to bid at lower levels. Hence, we don't see players bidding aggressively at this auction because of the increased amount on offer and also the tendency of the DMO to borrow more than they are offering. As a result, we expect the stop rate to close between 9.65 to 9.85. We expect the T-bills market to trade on a very quiet note today as the NTB auction takes center stage. The bonds, I'll conclude the Nigerian bonds market. The bonds market traded on a bullish note yesterday. The continuous show of interest across the benchmark curve with no corresponding offers in the market caused the bullish momentum to sustain in the bonds market yesterday, despite offers on 2026 and 2027 hovering around 12.6% levels. 2029 traded at sub 12.4 levels in the market yesterday, and this was basically because of the intense demand on that end. So our expectation for today basically is that the bonds market will continue to trade yesterday's sentiment in the absence of any significant show of offers across the benchmark curve. That concludes this for fixed income. Thank you very much.
Thank you, Marige. Next, we'll move on to our global equities desk, where Shane will give us updates across the global market. Good morning, Shane.
Good morning, Chima, and good morning, everyone. So, like Chima mentioned, we'll quickly give a roundup of some market in West Africa, equities market in West Africa yesterday, and a outlook. We start off in Ghana, where the index reversed the positive week opening with a 24 basis points loss. The 14.29 loss in EcoBank Transnational outweighed the mild recovery we saw in the likes of Benso Oil as well as Standard Chartered Ghana. Coming from a slightly lower base, the activity level improved significantly with over 670 as well as 330% increase in the volume and turnover traded in yesterday's session, which was largely on the back of the over 5 million units of the large cross we saw in the shares of MTN Ghana. Yet today returned stayed healthy at the 39.63% level, and going into today, we expect market to return to the slow trading pattern, bearing any large trade in some of the bellwethers like MTN or Cowbank or the GCB Bank. So we'll continue to watch out for that, and we'll bring you updates in tomorrow's session. Moving to the BRVM, the index closed yesterday's session by 20 basis points higher as the likes of SICOR, CFAO, and the likes also pushed the index higher. There was decline in the activity level. We saw both volume and value coming lower as the market stayed lower with investors largely sitting on the side at the moment. Market breadth also came in lower with 14 gainers and more losers, about 17 losers in that session. Yes, this session, we saw that all sector closed to positive to support the positive close. Going into today, we believe market will likely close positive today to consolidate on the previous day's upward movement. So we'll continue to watch out for that as well. So like we've also always mentioned, if you're looking at taking some exposure into these markets, please kindly get in touch with us. You can send us an email at dealing@vetiva.com, and you can also send an email to our sales team, sales@vetiva.com. So finally, moving to Nigeria, the market returned to the positive territory after we saw a 50 basis point higher close in that session yesterday. Dansem once again supported the gainers with a 227 bips appreciation, which was also supported by gains in GT Bank. We saw gains in Unilever as well as Oando. It was a quiet market as the highlight of the day was we saw a 10% appreciation in the share price of Okomu, which also largely supported that movement in the ASI as activity level improved by just 6% for the turnover, which closed at 1.6 million. Like we've guided, I think since late last week, we've seen market turnover between 1.3 billion and 2 billion in recent session, which still signifies that market is sentiment is slightly weak, but we believe as we continue to see some catalysts in the market would improve. Going into today, no deviation from previous session is expected. Slow trades with mixed pattern. We expect demand in Nestle and Seplat, like we've seen, to remain strong with little offers to match those bids. And I think, like we mentioned in previous session as well, we've seen Dansen gradually and continuously trading inching higher. We've seen it from the likes of from the level of 210 in the beginning of the week to about 225, which is trading now. So we'll continue to watch all those counters and bring back a report. That'll be it for the equities market. Thank you very much.
Thank you very much, Shion. Thank you very much, Shion. Next up, we'll be hearing from Temple Ashaju on updates from the African markets. Good morning, Temple.
Good morning, and thank you for this opportunity again. So we told you the other time that Kenya Tea Development Agency was making efforts to get listed on the Nairobi Securities Exchange. They have gotten an allotment done now for all the individual farmers. And now there are some 23 million shares that have been allotted to these farmers. Assets currently is around 36 billion shillings. And recently we understand that the agency, basically the reason for this move is because the agency has been accused of selling some of its assets to external persons that are not members of the tea development holding company. So that's what is fueling this demand. So basically with this listing, the individual farmers are now satisfied, and they do hope that they'll get listed with any moment from now. And that will at least ensure that they get approval before then. The approval will actually be sought from over 620,000 shareholders who will be members of the company before any sale of assets or fund aggregation can take place. Then in Rwanda, the East Africa country got the central bank released its annual report for 2020 yesterday. And then the report actually shows that the banking sector's gross loans and advances increased by 7% plus. And that's an increase from 2.7 trillion to 2.9 trillion Rwandan franc or thereabouts for December 2020. So we understand that the only sector that was down or that contracted, that didn't enjoy this loan, or that they had loans default on, were the mining and quarrying sector, personal household, trade, real estate, and manufacturing sectors actually benefited from the loans. For Senegal, we understand that there's close to setting up the 4.7 billion CFA franc Islamic Microfinance Bank that was being planned by the government. South Africa's GDP data was released yesterday. It shows an increase of 1% in the first quarter of for the first quarter of this year. That pushed the annualized growth rate to 4.6%. We understand that finance, mining, and trade industries help to bolster the growth. And of course, agriculture and electricity and gas and water industries were the two key sectors that constituted some drags. This is the third consecutive quarter of positive growth in South Africa. But we understand it is still 2.7% smaller or lower than the first quarter of 2020 when you do the comparison. Zimbabwe has continued to enjoy some growth in demand for tobacco. Sales data was released yesterday. Tobacco sales was up by more than 48% to over $374 million in 2021 Q1 or thereabouts. They've continued in recent time, they've continued to receive regular rainfall, and that would be like the heaviest in the last 3 years or thereabouts. And then again, the stability in the economy at the moment, as well as the free floating of the exchange rates in that country, have also seemingly boosted exports in recent time. Mauritius inflation is up more than 2.4% for the month of May, and that is also something that we are also tracking at Frontier Africa Report. These are the headlines that we have to share with you this morning. Thank you for listening.
Thank you very much, Abdul, for those headlines. Next up is we've come to the special edition, the special part of this edition, and we'll be having Ibuku Omoyeni, the economist at Vetiva Research, and he'll be speaking to us on fiscal sustainability, the bond price dilemma. Hello, Ibuku. Good morning. You have the floor.
Okay. Good morning, Chima, and good morning to everybody. So over the years, Nigeria has been setting the pump price of PMS, which we all know as petrol, below the international market price. And this actually gives rise to the issue of fuel subsidies. So contrary to what we know in conventional economics, where subsidies are incentives to encourage production, the Nigerian subsidy in this scenario is actually an incentive to import PMS and sell at cheaper prices to consumers. So as a result, we see that the subsidies of this nature do not have any direct linkage to production and employment in the economy, given the fact that our refineries are grounded. So when subsidies were introduced in the 1970s, following the oil price shock, we discovered that attempts to remove fuel subsidy has been matched with social resistance. So the first subsidy program has been bereft with a lot of sharp practices, as some briefcase companies declared and got reimbursed for subsidies for importing nothing. Although this has been slightly resolved with the NNPC's initiatives, including being the sole importer of PMS, yet we discovered that the perceived benefit of alleviating poverty has not been achieved. Consumers are actually worse off, as the country did not actually make good use of the oil boom to drive investment in infrastructure, which could have multiplier effects on our economy. So with regards to the social resistance to fuel subsidies, fresh in our minds is the Occupy Nigeria protests of 2012, where the government then attempted to remove fuel subsidies. The ensuing social resistance and protests actually led to a milder increase in the price of PMS. However, subsidies still remain in place. Just like they usually say that he who runs lives to fight another day. So we saw Nigeria face another major test recently with the pandemic-induced oil price crash. So as a result of the pandemic, we saw oil prices fall significantly from about $66 pre-pandemic to about $19 during the heat of the pandemic in February 2020. In fact, oil prices actually fell to the negative region in the futures market because of the oil demand shock. So while this was a shock on the oil market, it actually brought an opportunity for the federal government to remove fuel subsidies. Since oil prices were lower, it then made sense to remove subsidies and there will be an eventual reduction in fuel prices. So this actually made people to actually embrace the new regime. However, as economies gradually reopened, we saw that oil prices started gaining momentum, especially in the second half of 2020. And this actually led to a gradual adjustment in pump prices. However, when we saw vaccines being approved, likes of Moderna and Pfizer, we saw that oil prices actually picked up significantly, and it even went to as high as it was before the pandemic. But almost immediately, we actually saw that labor unions got into the scene and started resisting further increases in pump prices, especially as the country did not have what we would call automatic stabilizers. In advanced countries, once there is a down cycle, you have stabilizers, just like you have the unemployment compensation scheme in the US, where because of the pandemic, there are still relief checks to unemployed citizens. So those are the kind of stabilizers that were not present in the Nigerian economy. So as a result, the government had to suspend further pump price adjustments. And according to data, we saw that no subsidy was paid between April 2020 and September 2020. But in 2021, we actually saw this monster resurface called subsidies, and this time it was actually bigger. Why? Because we discovered that the government was spending an average of 120 billion naira monthly on subsidies. This is actually a huge amount. Historically, the government spends less than 100 billion on fuel subsidies, and it became a cause of concern because subsidies started competing with health or education in terms of budget allocation. In addition, we also discovered that more is spent on fuel subsidies than is allocated to the 36 of the Federation. So if you cast about back to 2015, we discovered that subsidies accounted for as little as 11% of the NMPC's remittances to the Federation account. But by January 2021, we saw that more was spent on subsidies than the states had to share. So in April, the NMPC actually disclosed that no remittances will be made between May and June. And this actually led the Nigeria Governors Forum to suggest that subsidies should be totally removed, which is a scenario that will see PMS prices jump to as high as 385 to 405 naira per liter. So just like the title of the webinar notes, the pump price dilemma that we have here is between welfare and fiscal sustainability. So as we have established that the continued embrace of subsidies has not really had a significant impact on consumer welfare as widely perceived. Instead, what we have seen is that investment that ought to flow into the downstream sector has been pushed away, and as a result, the jobs that would have been created are non-existent. On the flip side, we've also seen an increase in arbitrage opportunity, given the fact that our neighboring countries to the west, to the east, and to the north, in these neighboring countries, fuel prices are higher. So that creates an arbitrage opportunity as fuel is smuggled to areas with more attractive fuel prices. But we have to consider the fact that there's a unique case on ground, which is the COVID-19 pandemic. And as a result, if you abruptly remove fuel subsidies, it could actually thwart economic recovery and lead to social unrest across the country. So away from the pump price issue, let's go to fiscal sustainability. So we also see that fiscal sustainability has been under pressure, given the fall in the Naira. As the Naira falls, of course, the Naira value of subsidies will keep increasing. And as a result of the population growth, we will see subsidy bill rising. So while the federal government has decided to maintain subsidies in the near term due to the social concerns, the labor unions, and everything, we expect the burden to continually to mount on the country's fiscal balance. In the 2021 budget, the deficit projected was 5.6 trillion. And if you are going to prorate a 120 billion monthly subsidy bill, that could see that deficit rise by another 1 trillion naira. But at the state level, we also see the result of this issue. So it's already glaring at the state level. Only 3 states out of 36 states can independently live on internally generated revenues. Majority of these states depend on FAC allocations in order to run their states. And as a result of this gross dependence, this has given rise to austerity measures as state governments begin to cut back on expenditure. I think we've already seen this play out in Equities State, where there are reports that the government wanted to revert to the 18,000 naira minimum wage, which was the minimum wage before the current 30,000 naira minimum wage. So by the time we see more of these austerity measures, this would actually not be a good thing for the state government. So given the dilemma on ground, we actually have 3 recommendations. The first recommendation would be a gradual elimination of subsidies. And we actually think that this should be done on a quarterly basis. Why? This would give consumers time to adjust to the changes. And it's also important that all these changes should take place when there is FX stability, so that we would avoid implementing the reforms in times of multiple inflationary pressures, just like we have now. We have pressures from insecurity on agricultural food chain. We have pressures from the depreciation of the Naira. We also have pressures from the adjustment in pump prices. So because we're having these multiple challenges come to the consumers at once in the face, this would actually lead to higher inflationary pressures. We cast the mind back to the previous regimes where we had 5 naira adjustments in the pump price. It did not really have a significant effect, and there were no calls for protests or social unrest. So that strategy has to be revisited. And if we have a gradual increase in pump prices, this could actually help us to eliminate subsidies over time. And we should not actually wait for the next global oil shock before we actually take action, given the fact that as the demand for crude stabilizes, these changes should be effected gradually. So our second position would be for the state level, that there is a need for us to return to the tax revenue system being a major driver of revenue for their states. It may not occur suddenly, but we expect governments to work with the NIPC. So the NIPC is the Nigerian Investment Promotion Council, to attract investment into their states. We have seen 2 fiscal frameworks for attracting investment into the state level. And these are, one, we have the Book of State Reports by the NIPC, and we also have the Nigeria Poverty Reduction with Growth Strategy by the Presidential Economic Advisory Council. So these 2 documents actually entail the competitive advantages that each state and region of the country has, as well as the investment opportunities that investors can take advantage of, right? And by the time we're going to be seeing more investment coming, we'll see more jobs being created, we'll see increase in output, and on the same end, we'll be able to see an increase in both value-added tax, corporate taxes, and personal income tax. And that would be a more sustainable way of financing the state government. Ultimately, it will actually de-risk the fiscal profile of the state from depending on oil prices, considering the fact that the world is currently moving to a greener economy. And it's very possible in the future, once people start consuming fossil cars that run on fossil fuel, this could actually become a huge shock to the economy. But if we embrace these measures, the country can be recession-proof by those times. So our final proposition would be the enactment of investment-friendly regulations. This is actually important, considering the fact that there are recent calls for a global minimum tax. With this global minimum tax on the international scene, we could earn more money from multinational corporations. These multinational corporations, prior to now, were fond of allocating more money, allocating more profits to tax havens, that is, countries with low tax rates. And as a result, countries were competing among themselves by reducing their various tax rates in order to attract investment. But with the global minimum tax, this could improve the revenue generation capability of the country. Hence, there is a need to actually put in policies that would attract this foreign direct investment, and especially as several countries want to benefit from the AFCFTA agreement. Once they see that there's a market in Africa and they want to establish those industries in a country in Africa, it could be the #1 choice if we can actually implement such regulations. So conclusively, we can say that there are no hard and fast rules, because every process will take time and require commitment. There might be need for policy dialogues so as to avoid social unrest and backlash. However, Nigeria has the capacity to tackle the pump price dilemma. And if it can do so, this would actually drive home fiscal sustainability and welfare while eliminating the poorly organized fuel subsidies over time. So this is our proposition on the pump price dilemma. Thank you. Over to you, Chima.
Thank you very much, Ibukum, for the presentation. So we have about 2 minutes left on the session, and we can take at least one question from the audience. So if you have any question for us, you may raise a hand or send your questions in using any of the comment sections or chat box functions. So we see that we have a question from Abdul. Please go ahead, Abdul. Hello, Abdul, you may unmute yourself so that you can speak or ask your question.
Okay, good morning. Thank you for the presentation. So just on the issue of the sustainability of finances for the states, even after taking into account the FAC allocations, the states are really struggling. Do you think the states can afford the minimum wage, like in the immediate term? What would be the implication? Are we going to be seeing more bailouts from the federal government? Because really looking at the finances of the states, I just struggle to see how they can afford the minimum wage. And I know it's going to have a huge implication on the center. Thank you.
Okay, thank you very much for that question.
Please go ahead, Dibukun.
Okay, so thank you very much for the question. Just like I mentioned earlier, state governments might have to implement austerity measures if the fiscal burden starts coming on the states, right? Considering the fact that every state has different fiscal capacity. For example, Lagos State can pay more than the current minimum wage, while for some other states, they can only afford less than the current minimum wage. So there is a need for a reorganization of our fiscal federalism so that states can only pay what they can afford. It's actually important to actually reduce the debt burden, considering the fact that many of these states are even yet to repay the bailout funds from the 2016 recession. So if we could have more, like I said earlier, it's not going to be a fast rule. It has to be a gradual process. There has to be commitment to attracting investment by putting in place the right policies, because foreign direct investment is good by policies, not just by statements, right? So there have to be the right policies that will attract these investments into their states. And over time, but not immediately, we will see that taxes will improve from several sources.
Thank you very much, Ibukun. I hope this answers your question, Abdul. Just before we end the session, we'll just take one more question from Chukuma, and he would like you to do a quick recap of the recommendations.
Okay, so we have 3 recommendations. Number 1 is gradually eliminate subsidies by increasing fuel prices on a quarterly basis. The second recommendation is to return state governments to the tax revenue as the principal source of revenue generation, which would actually make them to seek investment from foreign direct investors. That's actually a medium to long-term position. While the third would be investment federal regulations at the federal level in order to take advantage of the opportunities in the global market, considering the global minimum tax and other opportunities. So those are the 3 major recommendations: eliminate subsidies, return to tax revenue system at the state level, and implement investment-friendly regulations.
Thank you very much, Ibukun, and to all our participants and attendees. This sums up the session for us today. It is past 9 a.m. We thank everyone for joining the session today. We hope that you continue to stay safe, and we would like to see you at the same time tomorrow. Thank you so much for joining. Good morning.